Well, what we do see in these earnings results is that we are in a recession. And we've been calling for a recession for quite some time, a lot of it based on excess inventory. So we think this is an inventory-led recession. And I think that's coming through loud and clear. We're seeing advertisers cut back dramatically. It seems like when Walmart and Target announced in May that they were loaded up with inventories, and this was far above what they had expected, and that they were going to have to do something about it. You know, a lot of advertisers started cutting back, cutting budget, saying, okay, this is a possible recession indicator. And as you know, we've just gotten 2 quarters, consecutive quarters of negative real GDP growth, but a lot of people still are fighting the notion that we're in a recession.
Hey guys, welcome back to Library of Wealth. Today we have the CEO of ARK Invest, Cathie Wood, with her strategy for success in an inflationary market, as well as what she sees coming for the next few months. Cathie observes that volatility has become the watchword in the industry, as most people now associate it with risk and uncertainty. When time horizons collapse, volatility increases. Wood has begun using volatility to her advantage, focusing all of her concentration on the highest conviction names. Wood stresses the importance of keeping a 5-year investment time horizon because in that time frame, there's an enormous difference between linear and exponential growth. She believes that Wright's law is the right answer in terms of exponential growth trajectories, and that the surprises along the way will be huge. Cathie sees that in the next 5 years, the market will be tough, but it's certain that the exponential growth trajectories have been accelerated by the turmoil in the labor market's logistics. Let's listen to Cathie Wood as she gives her opinion on today's market conditions and what's to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I think this is a recession, and I think what the Fed is really focused on is employment as a gauge. Employment is a lagging indicator. The CPI, the PPI, all of those are lagging indicators. If you look at initial unemployment insurance claims, they're up 50% from the low. So I do believe we're going to see some significant disappointment in the employment numbers moving ahead. And I also think based on what we're seeing from gold, the gold price actually peaked in August of 2020. Many people don't know that. And it's down near the low end of a range, a 2-year range. That's an important inflation gauge. And then copper price. The copper price broke down. It broke a 1-year trading range in the $4 to $5 per pound range, and it has come down hard. So I think all of these are signals that that inflation is going to come down. It's going to come down significantly, and that we're probably going to see some deflation. And we've been calling for that for quite some time as well. Typically, growth stocks will outperform as we move towards the end of a bear market and an end of a recession, because they're the new leadership. As inflation and interest rates were going up, we were facing incredible headwinds. That started in February of 21. And it looks like, at least so far, that we bottomed on an intraday basis based on our flagship strategy on May 12th. And we actually bottomed before the NASDAQ and the S&P did. The S&P broke down to new lows after that. So that was an early signal that we might be turning the corner here.
Cathie has also seen that in the public equity markets, it's been completely devastated in the past year as well. She also notes that last year, people thought that the economy and interest rates would go up, and even though inflation would rise, it would eventually be tamed. Instead, the supply chain issues didn't go away, and the fear of inflation and interest rates that had at first only begun to affect the market as a whole. Wood has noticed the 2-year Treasury and market is priced in at least 4 interest rate hikes.
To really turn the corner, the Fed does need to change its spots. It's getting all kinds of signals that it should, like an inverted yield curve. And yet, I think it's paying attention to lagging indicators of inflation, determined not to be blamed for letting the genie out of the bottle and causing another 70s-like inflation period.
Cathie believes in the research showing how profound changes are, how immense exponential growth will be, and how the equity market cap will explode in these areas. Wood continues by saying the move to risk off for most traditional asset managers means getting back to their benchmarks. And when looking at all broad-based benchmarks, there is no true innovation, and what innovation is being seen is mostly captured in mega-cap tech stocks. This has become a very disproportionate weight in numerous indices. The style of benchmark investing in traditional asset management has been supercharged during the past 20 years by first tech and telecom, then by the 08-09 meltdown. Wood says that research is becoming very benchmark sensitive, and portfolio managers and analysts are becoming short-term in their time horizons. The coverage in the traditional asset management world is very specialized, as it is broken down by industry, sector, and subsector, which, because of siloization, their ability to understand the convergences between the 14 technologies is inferior to Wood's team. Although the effects of the recent economic crisis are currently being felt by Bitcoin, Cathie highlights other nations that are also going through a currency crisis and haven't yet seen the worst of it. She thinks that the current economic downturn is just a preview of what is to come. Cathie continues by stating that some nations do not wish to depend on politicians to determine monetary policy.
So we have a 5-year investment time horizon. Just to give you a sense, for our flagship portfolio, our enterprise value, so that's both equity, market cap, and debt, enterprise market value to EBITDA, so effectively cash flow, is around 69 times. So I know a lot of people say profitless tech. We are not profitless on balance. We make the assumption that in 5 years, that number will be close to the market multiple on that basis, which is roughly 16 times. So in our models, and we're starting to publish our models because we really want people to understand this. We just published Zoom, we published Tesla. You can find them on GitHub. Experiment, change the variables we think will move the needle. And you can see how your assumptions might work into our 5-year investment time horizon. So we assume a 20% annualized headwind from declining valuations. And so our return expectation, which is quite substantial right now, is based solely on revenue growth and rising profitability.
Digital currency is used heavily in emerging economies, and Cathie predicts that decentralized finance will eventually replace the majority of the current financial services companies. According to Cathie Wood, ARK makes all of its research easily available to the general public, giving her clients a level of clarity they can't find anywhere on the market. She added that the traditional banking sector does not deserve shareholders of innovation, and that the investment group would continue to reveal its financial structure. Wood advises the business in which she has invested to make significant investments right now to capitalize on the enormous growth potential. Although Bitcoin is currently feeling the consequences of the current economic downturn, Cathie discusses other countries that are experiencing a currency crisis as well, and they haven't seen the worst of it. She believes that the current trajectory is merely a foreshadowing of what is to come. What do you guys think about Cathie Wood's opinion on the style of benchmark investing that is now common in traditional asset management today? Let us know in the comments below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.